Investors getting a check on the economy today. Payrolls rose by 64,000 in November. That was better than expected. And Treasury Secretary Scott Bessent says that's another sign that the economy is stabilizing.
We should think that 2025 was setting the table. 2026 is going to be a bountiful year. We have very good momentum coming into next year. The economy is broadening out. You can see it. Other sectors of the stock market away from big tech are doing very well. Let the economy do its thing, because the one big beautiful bill, there are so many parts to that that are kicking in. We've had 15% uptake in capital expenditure. Capital expenditure historically always leads to job growth.
Welcome to the Big Money Show, everyone. I'm Jackie DeAngelis, along with my co-hosts Taylor Riggs, Dagan McDowell, and Brian Bremberg. With us for the hour, Slate Stone Wealth Chief Market Strategist Kenny Polcari. Great to see you. So these numbers are coming in a very unusual package. For the first time in nearly 80 years, the Labor Department is releasing jobs data without a full unemployment rate, thanks to the government shutdown. So more uncertainty in a very uncertain time for the economy. This report is also backward looking, landing at a moment when workers and businesses are still feeling the squeeze by higher borrowing costs. But Wall Street, it remains upbeat. A new Bank of America poll shows investor optimism surging into 2026, with money managers betting the economy avoids a hard landing altogether. So there's a split screen. Jobs are still growing, shoppers still spending, investors feeling bullish. But with major gaps in the data, could this economy be walking a tightrope into the new year? And it's a good question. But before we get there, Kenny, I just want to get your read on these backward-looking job numbers. We got them delayed as a result of the government shutdown. You saw a big decrease in government hiring, which is what the administration is touting because it's trimming the fat. Right. But still, this number better than expected isn't a particularly robust, strong number.
No, but it's certainly better than the expectation, and it's certainly better than what we were prepared for last week when ADP came out with a negative number. So it's positive in that sense, right? And you take that, which I think is better. I agree with Scott Bessent. We're going into a better year in 26, but it's the unemployment number that I think people are going to focus on because it ticked up. But nobody should really be surprised because we've been talking about that number ticking up, and we went 2 months without a report. So it seems a little bit jarring going from 4.4 to 4.6. But remember, we had a couple of months in there where we didn't have a reading, yet we had those job losses, which we knew were coming. So I'm not really concerned about that number.
Okay. So I'm thinking about this and saying if the number is good, better than expected, the market tends to not love that because then it would mean that Powell wouldn't be as inclined to cut, which could be why you're in the negative, or the market could be looking at it and reading the news as regular news without having to invert it and just saying it wasn't a great number.
Well, and it could be a bunch of those things. But look, I don't think the Fed is cutting rates now, at least until May, when we get the new Fed chair. I don't think they're going to cut in January unless this data suddenly goes off the edge in the next 6 weeks, which I don't think it's going to do, right? So I think the market is fine where it is. I think it's going to adjust. Look, we talked about maybe the market being a little bit ahead of itself and this pullback and this need to churn, which is exactly what I see happening. I don't see a disaster by any stretch. While we see the market down a little bit today, I don't see it as a disaster. I see it as kind of a churn as we digest this data and get ready to move.
Okay. You usually like to dig in. What do you have?
I'm digging in. Did you see my screen? I got all sorts of charts going on.
Is your computer turned on?
Come on.
It's giving Taylor a run for her money there with your data.
That's right. So
Mine's not.
that's because the computer's in your head.
Mine's a shield for my stuff. The same. Go ahead.
Okay, so Kenny, unemployment rate, I agree, ticked up 4.6%. Right. But the labor force went up by over 300,000 people, okay? And the participation rate went up. So what does that tell you? It tells you people are looking for jobs. I like that. It doesn't mean they have a job. They're looking for jobs. And this year, according to the BLS, you've had a reduction in federal government employees of 271,000. Okay?
Right.
So what does that tell you? You've got people, what's the mantra? Deleverage the public sector, re-leverage the private sector.
Right, and look at what happened.
That's what's happening here.
But look what happened to the JOLTS report last week. It showed that there are employees looking for employees.
Exactly.
So I take that as a positive.
So I think we talked about the split screen coming in here, but to me a lot of the screens on one side. You've got spending, you've got hiring, you've got people looking, you've got investors investing. Is it all perfect? No.
No.
But it's pretty good, and I think the let's all assume crisis narrative of the economy could really start to wear thin next year, particularly when some of the big, beautiful law stuff starts to hit. So I like this report today. This report tells me capitalism is happening, which is what I want to see.
Right.
Okay. And also, you've got this Bank of America poll saying that investors are optimistic going into 2026. So I'm not sure how much attention they are paying to this backward-looking data. They want to see what Brian is talking about, the big, beautiful law come into fruition, and all the other spokes of the Trump economic wheel that supposedly will benefit them.
Yep, and all of that, the deregulation, all of that starting to come to fruition. J.D. Vance, I think, is trying to, when he was out speaking in Pennsylvania, saying that this will be one of the best tax seasons ever. I think trying to get people to hold on until the next couple months. But there's actually some interesting, more real-time data, and I come with lots of good news for you, Jackie, in this holiday cheer.
I like good news.
Despite taking an average of 15 weeks to find a new job, new openings are picking up. This is from Indeed, the job site. Job openings rose sharply in November. The net employment outlook by Manpower shows that net hiring, so hiring minus firing, strengths for tech, 35%, financials and real estate, and healthcare. LinkedIn just came out with the workforce report. Hiring rate is down from a year ago, but has been picking up since last month. So that bottoming out of October into November, indeed, is being confirmed by other employers who were out there. Retail sales, the control group, which factors into GDP, up 0.8% after a decline in the month-over-month numbers in September. And maybe this is also good news. Women's prime age participation, 25 to aged 54, near a record. Listen to this. This is the productivity miracle that Kevin Hassett keeps alluding to. Women, especially mothers of young children, entered the workforce at record levels. 83.8% overall for prime age labor for both men and women, near 20-year highs. So to Brian's point, people are coming back into the workforce.
Did you say men and women on that one? Both near 20-year highs?
Yes, but women much more stood out to me in that number.
Okay. I mean, despite all this, though, we still have some uncertainty. We have uncertainty with tariffs, which impacts small business, waiting on the Supreme Court, how the Trump administration will handle whatever ruling it is that they get on that. And also just waiting for the pieces of that wheel to come together leaves businesses kind of in a little bit of a gray area. According to the data that Taylor just came up with, perhaps we have bottomed, but that uncertainty lingers, Dagan.
There's a lot of uncertainty if you look beyond the broad market. And I'm going to tee up a chart that Taylor used. I don't know if it was last week, but it was 2 weeks ago. I didn't mean to surprise Taylor.
No,
but
do it. I love it.
So what jumped out at me, and I'll get into it at greater length, is just what's going on with Oracle, one of the hyperscalers, but kind of reaching, if you will, to come up with the capital to spend like a Microsoft or a Google or a Meta, as one example. And Oracle, so the reason I pulled this up,
I remember that.
this is real private non-residential fixed investment quarterly. This is all Taylor. But the line that goes way, that's just skyrocketing, is all data center spend. And the line for some months has been, this economy would be in a recession if not for infrastructure, AI data center spending. Well, the issue is how much more can an Oracle reach given it's already out borrowing, that Meta, for example, is entering into deals where it's using credit to continue this build out. But Oracle specifically, in data that came out in its 10Q after the earnings call, it detailed about $250 billion of lease payment commitments, where it's leasing the facilities that are being built, it's buying the nuts and the bolts that are going kind of the internals of these AI data centers, but not the buildings themselves. It's a big deal in tech, and it did smell of the dot-com bubble. When you have long-term, say, and this isn't just a theoretical example, but a short-term deal with OpenAI to lease your facility, your AI data center, say 3 years, but a 20-year lease on the actual building, that is a mismatch in the duration of your asset and your liability, if you will.
That's concerning.
Yeah. And Oracle specifically. So I thought, well, let me just look at these stocks, what's been going on. Look at the Qs, the NASDAQ 100. NASDAQ 100 the last month has been essentially flat. It's up just a little bit. But NVIDIA and Microsoft are both down 7% over that 1 month. Oracle is down 16% in 1 month. CoreWeave, which, hold your nose, is down 10%. That is telling you what the broad market is not. That the economy, if it is hitched that wagon to the AI star of the hyperscalers and the infrastructure spend, the economy in this country is going to look a great deal weaker than people are telling you and that the broad market is telling you. That's it.
Okay, one follow-up real quick. If the economy does look weaker than the market is telling you, but stocks keep going up because people don't know what else to do with their money despite the fact that the economy is weak, then you keep getting this distorted picture of what's happening.
Yeah, and it means it's a bigger signal to stay away.
Yeah.
That
Bubble.
that's just that's my theory. People are clearly jacked up about the Fed rate cut and even the short-term bond buying. I think it's a huge negative for the economy, the markets in general, more distortion. It sends a signal that maybe they can't find enough buyers for the amount of treasury supply that's coming on, but people like cheap and easy money.
Okay, let's stick with tech and take a look at Broadcom.
Look, if Dagan steals a chart, I steal a stock. Dagan, you
Yeah.
go Oracle, and I double down and I go Broadcom. Look, you're up 0.4% today, but in the last 3 days, you were down more than 18%, the biggest 3-day decline that we haven't seen since March of 2020. But Kenny, I did this for you because JP Morgan this morning says that overall, they're sort of a buy the dip on this. This is still their overall top pick within the semi.
Right.
They go up to a 475, which is a 24% increase from yesterday's levels, I believe. And they're saying that AI revenue could be $55 to $60 billion in 2026, up from just $20 billion in the last fiscal year. So declines like these, buying opportunities or more caution?
So I'm in the camp. I like this stock, but I'm in the camp at the moment that I'm a little bit more cautious because of everything we just talked about, because I sense there is going to be a pullback in the broader market in the new year, early in the new year. While I like it and it is on sale, I can sit here and watch it for a little bit and see how it shakes out. So I like the name, I like the space, but I'm going to hold off on these names, whether it's CoreWeave, whether it's Broadcom, whether it's Oracle, because they're all down below. They're down double digits in bear market territory now, right? If you look at the highs. And they're below all their trend lines. So I just want to see how they play out. While, I own tech, we own tech, so we're in it. But there's no reason in my mind to jump right back in today just because it's down. I want to see how it flushes out, especially once we turn into the new year, because that's where I think we're going to see more pressure.
Okay, fair point.